Hello everyone, welcome to Akira's Academy of Accounting and Finance, and today we have reached on our third chapter, that is recording of transactions. Okay, so in the first two chapters we discussed what is accounting, we discussed why there is a need to do accounting, and now we are going to discuss how to do it, how to record the transactions in the books of accounts. Okay, so let's start with an example as usual. Now let's say you want to buy a mobile. Okay, you went to a shopkeeper, you got a mobile, you paid money, and you come back home. Okay, something happened to your mobile, the mobile is not working. You again go back to the shopkeeper and you said this mobile is not working. He said, what proof you have that you got a mobile from my shop only? Now here comes the point. Like at that point, you didn't take any evidence from that shopkeeper that you have purchased a mobile from that particular shopkeeper only. What evidence, what proof you have that you have purchased? You can have got it from somewhere else also. But what proof you have that you got it from that particular shopkeeper only? That is why it is always mandate, it is always required that you get a bill of it, that act as a proof, that act as an evidence that you have purchased a certain thing from particular shopkeeper. Okay, so when now you give the bill, that in that bill it will be mentioned, okay, on this particular date you have purchased this particular mobile for amount rupees this much. Okay, so that proof, that evidence is called what? Source document in terms of accounting. Now the business is dealing in so many transactions. Okay, sometimes they are purchasing things on credit, sometimes they are purchasing things on cash, sometimes they are depositing money in the bank, sometimes the purchase return is coming, they are doing purchase return, their sales return is coming. So like they have to prepare, they need to have multiple source documents which act as an evidence that these transaction has occurred, then only they will be recorded in the books of accounts. So what are those source documents? It could be cash memo, if it has been happened in cash. There could be invoice or bill if the transaction is on credit. Okay, if you have received a receipt of it, the payment of the transaction, like you have seen the receipt so many times, just look at it nearby, like when you make a payment for your school fees, when you make a payment for your tuition fees, when you go somewhere and you park your vehicle and you just get a 10 rupee receipt that you have parked your vehicle over here, that is a proof, that is an evidence, that is called a receipt. Or there's a pay in slip. Visit a bank, visit a bank, if at all you have been earlier, that's good, but visit a bank one time, deposit money, the bank will not accept like you took cash and just give money to the bank, and the bank will not accept it like that. You have to fill a form, you have to fill a pay slip wherein you will mention the details, like how much money you are depositing in the bank. Not even that, you have to mention how many 100 rupee note you are depositing, how much 200 rupee note, how much 500 rupee note, every detail you have to mention it, and you will get a counterfoil of it. So the pay in slip, sometimes the company put a purchase order, like in the case of a shopkeeper who sells the mobiles, he will place a purchase order with the salesperson, like I need 30 units of this mobile, I need 40 units of power banks, I need this much amount of headphones. So that is the proof that I am placing this much amount of order with you. Okay, purchase order. Now there are other things also, like debit note or credit note. Okay, now we are going to deal with it later. It's just the thing, it's just a document which says that you have purchased something from somebody and you are returning it. So for that you prepare, or when the sales have been made and somebody has returned the goods to you, sales return, purchase return, at that time you are supposed to prepare debit note and credit note. Okay, so these are the source documents which the organization has to maintain in a with themselves as a which act as a proof, as an evidence, like we discussed in the objectivity concept also, that the concept, what does it require? It requires a proof, it requires a evidence when they are recording the business transactions. So and then they prepare voucher. The organization prepare voucher for all the transaction that they are dealing with. May it be cash, may it be non-cash. They prepare cash voucher, they prepare non-cash voucher. This is easy to understand. Cash voucher, anything dealing in terms of money, they prepare cash voucher. Non-cash voucher, uh, if at all the company is buying goods on credit, okay, or if they are selling goods on credit, or there is a term called depreciation. We are going to discuss about it, and we have discussed earlier also, but let me just give you in nutshell, let me just tell you in a nutshell that depreciation, you have already purchased an asset, okay, and now that asset is going to be used for a period of time, but you are using that particular asset in that particular year, so you are reducing that value of an asset, you, because you have used that asset for that particular year, so you charge depreciation. In that there is no cash transaction, right? Or else there are bad debts. Like bad debts, earlier also I told you that there are debtors whom you have sold the goods on credit, they are called debtors, okay. Now you know that this particular person is not going to give my money back. What you do it, you charge, you consider them as a bad debt. Now there is no monetary transactions, okay. So then you have to prepare non-cash vouchers. Cash vouchers, there are simple voucher, like I said, here the sales seller will prepare, he sold mobile to you, he got a money, okay. There is two aspect, dual aspect, give and take aspect. In accounting, we consider those aspects, we record those transactions in terms of debit and credit. So something has gone and something he has received. So there are two accounts, debit account and credit account. So what he will do, he will prepare a simple voucher wherein he will write the name of the firm. In that voucher, what will be? The name of the firm will be there. He will mention that there are multiple vouchers. Okay, so the voucher number will be there. Okay, like serially it will be in a serial wise it will be mentioned, like okay 001. In that way, the date will be there, date on which the transaction has occurred. Okay, mind it, on which the transaction has occurred, that date is to be recorded and not on the date which you are recording. Okay, so the date will be there, the name of the person to whom the transaction has occurred, there will be a debit account and there will be a credit account. Okay, then amount, how much amount. The narration is simply, we call it as an explanation regarding the transaction. Okay, being goods purchased, being goods sold, anything. Okay, so the narration. Now who has prepared it? In large organization, there are different, the roles have been designed to different people. So somebody is there who will prepare it, so he has to write his name and signature. Similarly, once it has been prepared, it has to get authorized by somebody. So it will be mentioned like it is being authorized by whom, that person's name and signature. Okay, simple, like these are the basic things which need to be there in the voucher. Okay, now the firm, how the firm is preparing, firm can write voucher number here, firm can write date here, how they are preparing it. These are the basic requirements. How the firm is preparing, it's up to them. So this is the simple voucher. One account is debited, one account is credited. But there are different vouchers. There's a debit voucher and there's a credit voucher. Now, let me just rub it. Now, what is a debit voucher and what is a credit voucher? Before dealing with it, let me just tell you something. Um, there are rules of debit and credit, okay? And there is one rule which deals with, there are nominal account, there is real account and personal. Okay, these are the three rules. We are going to discuss about these rules. Right now, I just want to focus on this real account. The rule of real account says what? Debit what comes in, credit what goes out. It mainly deals with the assets. Cash is an asset. What does it say? When cash come into the business, debited. When cash goes out of the business, credited. Okay, so debit account and debit what comes in and credit what goes out. Now what we discussed simple voucher. Now comes compound voucher. And for compound voucher, we prepare debit voucher and credit voucher. Okay, compound voucher is what? When there are multiple debit and one credit, or else when there are multiple credit and one debit. What one credit and what one debit will be there in case of cash voucher? Only cash. Okay, either cash will be debited, either cash will be credited. When cash is debited, when somebody is giving me money, when the firm is receiving money, because cash comes into the business. And when cash account is credited, when cash goes out of the business. Okay, now let's say the salesperson who is selling mobile phone, he sold, you went to that salesperson, shopkeeper, you got mobile, you got headphones, you got power bank, you got any other electronic equipment. Okay, so you buy multiple things from him. Okay, so what you got, what everything goes out and what you give money. So cash comes into his business. So cash account is debited. Cash account is debited. What goes out from his business? Mobile, headphone, power bank. Okay, so these things goes out from his business. Now when we prepare debit voucher, when we prepare credit voucher, when there are multiple transaction is happening, when cash account is debited and there are so many accounts which are being credited, we will prepare credit voucher. Okay, cash comes in, cash account, single account is debited. How to prepare debit voucher and credit voucher? Okay, so here all the things have been credited. So what we will prepare? Credit voucher, wherein we will mention the details, what things have been, which account have to be credited. So we will mention mobile, we will mention headphone, we will mention what else we bought? Power bank. So these accounts are credited because there is only one account which is debited, and that is cash. Okay, so when there are multiple credits, we prepare a credit voucher. When there are multiple debits, like in the same way, for example, that shopkeeper is buying goods from somebody. Okay, from he is buying mobile phones, he is buying all these kinds of electronic equipments, he is buying from somebody. So multiple debits are happening, and what is going out? Cash is going out. Cash account will become credit, and multiple debits are happening, so we will prepare debit account. Then it will be called debit voucher. The other details will be the same, wherein you have to mention the name of the firm, the voucher number, the date, amount, explanation, that is narration, authorized by, and prepared by. Who has prepared it and who has authorized it. Other details will remain same. There are multiple debit happening, so you will prepare debit voucher. There's only one credit, cash account is being credited. Is it simple to understand? Only cash account is credited. We prepare one, we mention it in the credit account. There are multiple things we are buying, multiple things are being debited. We prepare debit voucher. Multiple things we are selling, cash is coming into the business, cash account is being debited, multiple things going out from the business, so other things are being credited, so we will prepare credit voucher. So what is it called? It is called compound voucher. Now we discussed simple voucher, one debit, one credit. One debit, one credit. Okay, we discussed compound voucher. What is compound voucher? Multiple debit or credit, then it will lead to one credit or one debit. Now comes complex voucher. These are just the names. It's easy to memorize it. Complex voucher, easy. Multiple debit, multiple credit. Same example I am telling you, multiple debits, multiple credits. That shopkeeper sold you mobile phone, that shopkeeper sold you headphones, power bank, and that shopkeeper is ready to accept the old mobile from you. Okay, so the old mobile also comes into the business. He got a cash from you, he got other electronic equipments, he is ready to accept it. So there, what happens? Multiple debits are happening, multiple things are coming into his business, multiple things are going out from his business. So when to prepare complex voucher? When there are multiple debits and multiple credit. This is, in this you have to prepare debit account, the accounts which are being debited, mention everything. Credit account, the account which are being credited. The other details will be the same. The name will be the same, name of the firm, the date will be the same, voucher number will be the same. Okay, who has prepared it, who has authorized it. Okay, the amount you have to mention and narration. Okay, these things are going to remain the same in all the types of voucher, may it be simple voucher, may it be compound voucher, may it be complex voucher. The other details will remain the same. It's just the difference of how many transactions are happening. Now these vouchers, they have to record it, they have to keep it in their books in a chronological order. And they have to maintain these vouchers for a specific period of time, maybe 5 years, 7 years. That is somewhat they have to maintain these vouchers, because their books of accounts are going to be audited, or else there is a tax assessment, anything. They have to maintain these vouchers, and that too in a chronological order. On the basis of this voucher, the transactions are recorded in the books of accounts. We identify the transaction, the process of accounting, we measured it, when to record it, vouchers are prepared, vouchers are there, there is a source document which act as a proof or evidence for those transactions, and then we record it in our books of accounts. Okay, I hope you got all these things. The next topic which we are going to discuss is accounting equation. Okay, the next topic that we are going to discuss about is the accounting equation. Now in maths you have done this equation which says A is equal to B plus C. In accounts, what's the equation? A is equal to L plus C. Now what is A? A is assets, L is liabilities, and C is capital. Okay, what is asset? Asset is something what is being owned by the firm. which the firm owns. And what is this? This is something what the firm owe to somebody. Liability, this liability is third party liabilities, and capital, that is the owner's, the amount that the owner has invested in the business. Okay. Now, as we discussed earlier also, that the owner is different, the entity is different. So the entity is liable to pay the owner the capital amount. And where does we represent it? In the balance sheet. What is balance sheet? It is a statement showing the financial position of a business. What is the financial position? Where does the business owns? What are the business's assets? What are the business liabilities? So that is called balance sheet. It is a statement showing the financial position of an entity. It's a statement. And balance sheet, why it is being termed balance sheet? Because the assets are always going to be equal. They are going to be balanced. The assets will always be equal to liabilities as well as capital. Okay. How? Let me give you the same example. The salesperson, the mobile shop owner. Now, when he started the business, he must have got some capital to start his business, and he got capital in the form of cash. So, what is his capital? He got a capital, let's say 10 lakh rupees. At the same time, when the capital becomes the liability of the firm, what comes in? The cash. What is cash? The asset. So the cash also increases by 10 lakh rupees. We have discussed the classification of assets, wherein the assets are being classified into fixed assets and current assets. Okay, let me just again go through it. Fixed assets, tangible assets, intangible assets. Tangible assets, which we can see, which we can touch: buildings, land, plant and machinery, furniture, vehicles. These are all fixed assets which we can see and which we can touch. Intangible assets, which we cannot see, which we cannot touch, which has built up because of the reputation of a firm. Okay, goodwill, patent, copyright, trademark, these are all called intangible assets. Okay, other fixed assets, non-current investments. If I have invested certain amount somewhere, these are non-current investments. Then there are current assets. What are current assets? Why we say it current asset? Because they will be used within an year. Okay. Now, what things will be used within an year? Stock, our cash, cash in hand, cash at bank, debtors. These all are called current assets. There are other bifurcation. There are other things, like when you are giving somebody money. Let's say for the salary, you are giving an advance salary to somebody. Okay, advance salary. So that advance salary become your asset, and it will be used in that particular year. So fixed assets, current assets. If something if something increases in assets, the same amount will be increased in liabilities or capital. Let's say if I got a stock, I purchased, the mobile shop owner got the mobile from somebody on credit. Okay, he got a mobile, 30 mobiles for rupees 30,000. Okay, so 9 lakh amount of stock comes into his business. Stock is what? Fixed asset. So the stock comes into his business. He got it on credit from somebody. So what happened? The liability increases by the same amount, 9 lakh. And that is what the accounting equation says, that the balance sheet is always going to be equal, always remain, it will be balanced. The assets are going to be equal with liabilities and capital. I am going to give you a detailed example of this. Okay. Okay, so let's start with an example. Mr. Aman started his mobile business. Analyze the effect of each transactions on assets and liabilities and show that the both sides of accounting equations remains equal. That is, A, assets is equal to liability plus C, that is capital. Okay, so now what does the first transaction says? Started the business by introducing cash of rupees 5 lakh and stock worth rupees 50,000. Okay, let's start with the solution. The first thing that comes into business is stock and inventory. So stock, the cash is an asset and inventory asset. He introduced by introducing cash worth rupees 5 lakh and stock 50,000. So the capital will be 5 lakh 50,000. So now the total is of assets 5 lakh 50,000 and total of liability plus capital is 5 lakh 50,000, right? Second transaction says deposited rupees 3 lakh into the bank. Now, bank, my asset. Bank, one more asset increases of Mr. Raman. So what the second transaction says, he deposited 3 lakh into the bank. So the bank goes 3 lakh from the cash minus 3 lakh. So now the cash remains 2 lakh. Inventory remains the same, 50,000, and capital remains the same, 5 lakh 50,000. Okay, so now the total of asset is 2 lakh plus 50,000 plus 3 lakh, that is 5 lakh 50,000, and liability plus capital 5 lakh 50,000. The third transaction says purchased furniture worth rupees 80,000 and made payment by check. Furniture, what is furniture? Furniture is his asset. One more asset increases in the business, that is furniture. Purchase furniture 80,000, payment by check. So from 3 lakh goes 80,000. What remains is 2 lakh 20,000. Inventory will remain the same and cash is the same, that is 2 lakh. Okay. Here the capital will be the same, that is 5 lakh 50,000. So now the total of assets is how much? 2 lakh plus 50,000 plus 2 lakh 20,000 plus 80,000, that is 5 lakh 50,000. And here my liability plus capital is 5 lakh 50,000. Let's go on the fourth. Purchase goods on credit for rupees 70,000 from Mr. Rajiv. Purchased goods. He purchased goods on credit. Credit means now he is liable to pay to Mr. Rajiv. That means Mr. Rajiv becomes his creditor. his liability increases by rupees 70,000 and goods come into the business worth rupees 70,000. So my inventory increases by 70,000, 50,000 plus 70,000. So total inventory is now 1,20,000. Cash same, bank balance same 2,20,000 and furniture 80,000 plus now capital is 5,50,000. So now total will be of assets and liabilities plus capital will be 2 lakh plus 120 plus 220 plus 80. That becomes 6 lakh 20,000 and liabilities plus capital 70 plus 5 lakh 50 becomes 6 lakh 20,000. So now we have reached on the fourth transaction. You can see the way my assets are increasing, it is affecting my liabilities and capital, or else the assets increases, one asset increases, one asset decreases. Because of this, my assets will always be balanced with liability plus capital. Let's move on to the fifth transaction. What does the fifth transaction say? Sold goods worth rupees 40,000 for rupees 55,000 on cash basis to Mr. Soham. What he did? He sold the goods 40,000 worth on cash basis to Mr. Soham, right? He sold the goods. So inventory was my 1,20,000. Goods went out of the business worth rupees how much? 40,000. Okay. This is crucial. Just understand. For rupees 55,000 on cash basis. So cash was how much? 2 lakh. How much amount he received? 55,000. Okay. Now what happened? The goods were worth rupees 40,000, was sold for rupees 55,000. So 15,000 was what? It is profit. Who will get the profit? Obviously the owner, that is Mr. Aman. So his capital increases by 15,000, 5,50,000 plus 15,000. So the capital increases, it becomes 5,65,000. Okay. Other things will be same. Here the cash will be now 2,55,000. Inventory was being sold. We will minus it. Here we will add it. Cash come into the business. Here we will minus it. So it will be 80,000. Bank amount in bank will remain same, 220, and furniture 80,000. So now the total of assets is how much? Here the liability will remain the same. Now the total will be how much? 6,35,000. 220 plus 80, 3 lakh, 3,80,000, 3,80,000 plus 2,55,000, that is 6,35,000. My total of assets is 6,35,000 and total of liability and capital, that is 70,000 plus 5,65,000 is 6,35,000. Okay, fine. The transaction says withdrawn rupees 20,000 from the business for personal use. He withdraw that amount from the business for his personal use. Withdrawn means that is a drawing. Okay, if he is withdrawing amount rupees 20,000, that means his capital is reducing. His capital is reducing and as well as the cash is reducing, right? So what was the cash? 255. Now he is withdrawing rupees 20,000 from the business. So the capital reduces by 20,000. It will be 5,45,000. And here the cash reduces by rupees 20,000. So the cash will be 2,35,000. All the other things will remain the same. So the total will be how much? So the total will be how much? 2,35,000 plus 80,000, that is 3,15,000. 3,15,000 plus 220 plus 80, that is 6,15,000. Here the liabilities plus capital 545 plus 70, that is 6,15,000, right? What does the seventh transaction says? Made payment to Mr. Rajiv of goods through check. Mr. Rajiv, how much amount of goods we bought from him? 70,000. We paid him through check. So my bank balance will reduce through check 70,000. It will reduce by 70,000 and here 70,000 worth of my liability will reduce. Now I don't have any liability to pay. It's nil. Okay. The capital will be the same, 5,45,000. Here it will be 1,50,000. Cash 235. Inventory 80,000. And furniture 80,000. Okay, so the total of my assets will be how much? 235 plus 80, 315, 315 plus 1,50,000, that is 4,65, 4,65 plus 80,000, that is 5,45,000. And here liabilities plus capital will be 5,45,000. Okay. The eighth transaction says sold goods on credit worth rupees 20,000 for rupees 25,000 to Mr. Akash. Okay. Akash, we sold goods on credit. That means Mr. Akash becomes my debtor. Asset increases. Now I sold it on credit. Goods worth rupees 20,000 for rupees 25,000. So my inventory will reduce by 20,000. Now it will be 60,000. At the same time, my debtor will increase by 25,000. Now I sold it on profit, 5,000 profit. Who will receive this profit? Obviously, Mr. Aman. So his capital will increase by 5,000. 5,50,000. The cash will remain the same, 2,35,000. Inventory 60,000. Bank balance same, 1,50,000. Furniture 80,000. So the total of all my assets is 5,50,000. And total of liabilities plus capital is 5,50,000. Okay. Now the ninth transaction. received payment from Mr. Akash through check for rupees 25,000. So Mr. Akash make the payment to Mr. Aman, and so the data reduces by 25,000. Now there are no datas. Okay. Payment through check. My bank balance is 1,50,000. It will increase by 25,000. So now the bank is 1,75,000. Furniture same, inventory same, and cash in hand same. Similarly, here the capital will remain the same, that is 5,50,000. So now the total of asset is 235 plus 60, 295, 295 plus 175, 3,70,000, 3,70,000. Oh, sorry, 4,70,000, 470 plus 80, that is 5,50,000. Okay, and we come to the last transaction, which says purchased goods worth rupees 50,000 for cash and for rupees 30,000 on credit from Mr. Kishore. Okay, goods purchased from Mr. Kishore worth rupees 50,000 for cash. So here my cash will reduce by rupees 50,000. Okay, and for rupees 30,000 on credit. So my liability will increase by 30,000, and my stock will also increase. What is my stock? 60,000. Purchased 50,000 on cash plus 30,000 on credit. So total purchased is, so total of inventory is 1,40,000. Here the bank balance will be the same, 175. Furniture 80,000. No debtors, and here liability plus capital 5,50,000, and here 1,85,000. So now the total of assets is how much? 5,80,000, and assets plus liability is 5,80,000. Easy. So now you got to know in all the transaction, whatever transaction we dealt with, all the transaction, as and when any of my asset is increasing, the effect is happening on the liabilities or capital, or else on the asset. If asset increases, one asset is either reducing or it is affecting the liabilities or capital. And always this will be equal to this. Assets will always remain equal to liabilities and capital. They will always be balanced. Okay. Now we will start with the another topic, that is rules of debit and credit, when to use debit and credit. Okay. The next topic that we are going to discuss about is using debit and credit. Now, what is debit? What is credit? When you are dealing in accounts, we have discussed earlier that there are two accounts that are being affected. Okay. So that accounts, we how to write it, how to denote it. One account we will debit it, one account we will credit it. Okay. Now let's say your example only, when we discussed about the mobile phone, there was two transactions that were being affected. Mobile phone, you purchased a mobile phone, you took the mobile phone, you give money for that. Okay, so there are two. It's now when to use, how you will deal with it. Like, okay, this account I'm supposed to debit it, this account I am supposed to credit it. So there are certain rules of debit and credit, and I am going to discuss with you the two approaches. You deal with it, you decide whichever approach is comfortable for you, you can take that approach. So there are two approach. One is traditional approach. These are the golden rules. I just love and follow these rules. Okay. And there is a modern approach. Modern people, modern approach. Okay. So the traditional approach, every transaction have been categorized as per the traditional approach. There are three accounts: personal account, real account, and nominal account. So whatever transaction are happening in the organization, those transactions will either belong to personal account or real account or nominal account. And what are the rules of these personal, real, and nominal account? When I say personal account, it relates to the person. It may be a firm, organization, uh, any person. Okay, so when I say personal account, it relates to firm, organization, person. And what are the rules? We debit. This DR is the abbreviation of debit, and CR is the abbreviation of credit, and you are going to use this. Okay, so personal account debit the receiver, and credit the giver. Okay, now when I am purchasing goods on credit from somebody, that person account, goods come to my business, I purchase the goods. Now that person is my creditor. He is the giver. Okay, he is the giver. So his account, I am liable to pay to him. His account will be credited. Okay, real account deal with your assets. Okay, whatever assets we discussed, the assets, real account deal with those assets, the properties, the cash, everything. Okay, all the things are being dealt in the real account. And what are the rules of real account? Debit what comes in, and credit what goes out. Just the previous example I am taking. Okay, and I am going to use both this personal account and real account rules. Now when I said I purchased the goods on credit, okay, from Mr. Aman. Okay, now when I purchase the goods on credit, mind it, on credit, when I purchase the goods come in. So purchase account is debited, and what, whom I am liable to pay? He is the giver of those goods. So Mr. Aman account, his account is being credited. We are going to deal with how to pass these entries, but just to let you know how I am using these rules in the transaction. So I purchase the goods come in. First rule of real account, what comes in, debit what comes in, goods come in, purchase account is debited. The second rule, I am dealing with somebody, with a person who is the giver of those goods. So the personal account credit rules, credit the giver, so to Mr. Raman account. Now in this case only, if I am purchasing goods on cash, okay, what is happening? I purchase the goods, I give the cash. Okay, so purchase account debit, and instead of Mr. Aman, I'm not dealing with person, I have already paid to that person. What goes out from my business? Cash goes out. So I credit the cash account. Purchase account debit, goods come in, debit what comes in, and the real account second rule, credit what goes out. What goes out? The cash goes out. So to the cash account. Okay, and then there is a third rule, that is a nominal account, which relate with expenses and income. All the expenses and income are going to be dealt in the nominal account. So what are the rules? Debit all expenses and losses and credit all income and gains. Okay. Now, whatever expense I am incurring, I will debit it. Whatever income I am earning it, I will credit it. Let's say an example, I have to give salary to somebody, okay, to the employees. Salary, it's an expense for me, okay, and I give it in the form of a cash. So, expense, debit all expenses and losses. So, salary account will be debited. And what goes out? The cash account. Cash account comes in which account? The real account. Okay. So what goes out? Cash goes out. So to cash account. The cash account is being credited. Similarly, if at all I am getting a rent for the go down which I have rented to somebody, now that rent is my income and that rent I received in the form of a cash. So cash account debit. Debit what comes in cash comes into my business. And what is it? Rent. Rent is an income. So credit all income and gains to rent account. Okay. Like any transactions that you are dealing, all those transactions are going to belong to the personal account, real account or nominal account. And these are the golden rules. Whenever you are dealing with transaction, just remind yourself, oh, is this belong to a person? Is this belong to my assets or properties? Or is this belong to some of the expenses or incomes or gains or losses that I am incurring? Whatever it is, deal with it. Personal account, debit the receiver, credit the giver. Real account, debit what comes in, credit what goes out. And nominal account, debit all incomes and gains, debit all expenses and losses, credit all incomes and gains. Okay, this is the traditional approach. Now I will let you know the modern approach, right? Now, modern approach, you just need to remember one thing. Anything like when we study the accounting equation, what we say, assets equals to liabilities plus capital. So there are 5 things that we are going to deal with. One is assets, one is liability, one is a capital, and the other one is expenses and incomes. Expenses is not equal to income. This is just to let you know that these are the 5 terms that you are going to deal with it. Assets, liabilities, capital and income. Okay, this approach is also very easy to understand. It's not difficult. You just need to remember when there is an asset, if the assets increase, if the asset increase, like I say, I got a computer, now I got a computer, my assets have increased, I will debit that particular asset. And if my asset decrease, I will credit that particular asset. I have 2 buildings, I give one building to somebody, that building, now that asset of mine decreases, I will credit that asset. Okay, let's say same building example, like let's say I sold that building. Okay, I get a cash out of it. Okay, he gave me a cash or a check. Let's say building for building, so much amount of cash you can't receive, so you got a check for it. Now what is it? Cash at bank, check is an asset, and building which I sold, that is also my asset. Okay, now when I received a check, okay, what happened? My asset increased. What I will do here? I will debit it. Okay, building, my asset decrease. What I will do it here? I will credit it. Similarly, let's say I purchased stock. I purchased certain goods. Okay, the stock, then what happens to stock? my stock increase, I will debit it. And what I gave cash to that person. Cash is an asset. Cash decrease, I will credit it. Easy, no rocket science, right? So this is what about asset. The same goes for expense. Okay, when my expense increase, I will debit it. When my expenses decrease, I will credit it. Okay, now same salary example. I give salary to somebody, my expenses increases. Okay, salary, my expense increases. What I will do? I will debit it. And what I gave cash to that person. So my asset, here my expense increase, I debit it. Here my cash, I am giving in cash. My cash is an asset. What happens? It decreases and I credit. Okay, easy. This was for asset and expense. Let me tell you about liabilities, capital and income. For all these things, if it increase, I will credit it. If it decrease, I will debit it. Let me again explain you with an example. Liability. Now you took a loan from a bank. Okay, now that loan is a liability for you. It's a liability. So what happens? Your liability increase. Bank loan is a liability. Liability increases. What happened? You will credit it. You, how they gave you? In the form of a check. Okay, check, bank, like cash at bank we said. Okay, so what is this? This is my asset. This, what happens to the bank amount? It increases. It increases. What am I supposed to do? I'm supposed to debit it. Two effects, one debit, one credit. Okay. Similarly, if I say capital, let's say capital. Capital, if I get something from for the business, for the organization, if the owner gives certain amount of money for the organization, okay. So what happens? Capital, what happens to capital? It will increase. What I will do? I will credit the capital account. How the owner is giving? It is giving in the form of cash. Okay, in the form of cash, he is bringing certain amount of money in the business. What happens? The cash increases. What is cash? Cash is an asset. I will debit it. Okay, now capital, if I am withdrawing certain amount of money from the business, okay, what is it called? It is called drawing. It is called, if I am withdrawing certain amount of money from the business, it is called drawing. Now when I am withdrawing certain amount of money, what happens? My capital decrease, my capital reduces. What happened? My capital reduce. What I will do it? I will debit capital account, and this thing are going out from the business, like the cash is going out from the business. What is a cash? Cash is an asset. That asset reduces. I will credit it. Okay, easy, fine. Then comes income. Now income, the rent income which I received for my go down. My rent is an income. It increases. It increases. What I will do? I will credit it in the form of cash. I received that income. What happens to cash? Cash also increases. I will debit it. Okay, easy. So the rules, as per the modern approach, the rules of assets, expense, liabilities, capital and income. First, you have to understand that these are the only 5 things based on which each and every transactions are going to happen in the business. Whatever transaction are happening, either it will affect to the assets or the liabilities or the capital or the expenses or the income. Okay, so when the assets or when the expense increases, we will debit that asset or expense. When the asset or expense decreases, we will credit asset or expense. Similarly, for liabilities, capital and income, if my liability or capital or income increases, I will credit it. If it reduces, if decrease, I will debit it. Same, one more example, like if, for your clarity, like how liability reduces if I purchase goods on credit, right? Okay. Now I purchase the goods on credit. First, what I did, I purchased the goods. Stock come into my business. My stock is an asset. It increases, debited. From whom I am purchasing? Mr. Aman on credit. Mr. Aman becomes my liability. So my liability also increases. What I will do? I will credit it. Now I am paying Mr. Aman the final amount. Okay. Now what happens here? My liability reduces. When I am paying to Mr. Aman, what I will do? My liability is reducing. So I will debit it. How I'm paying? In the form of check. Okay. So cash at bank is my asset which is reducing. When my asset is reducing, what I will do? I will credit it. Okay. These are the two approaches. Whatever you are comfortable with it, you can follow any approach. Now we will deal with an example. I will take a full illustration. Okay, so we are going to deal with the same example for the rules of debit and credit. I have added 3 more transactions. We will deal with it when we will do the rules of debit and credit. Okay, so what does the first says? Transaction: started the business by introducing cash of rupees 5 lakh and stock worth rupees 50,000. So here cash is an asset. Okay, I'm taking a modern approach, right? As it is being given in your book like that, so I'm taking a modern approach. So cash, asset, it increases, I'll debit it. Stock, okay, my stock is an asset, that also increases, I'll debit it. And capital, capital is a owner's fund. Liability, that increases, I will credit it. Okay, so this is the T format. As I have said, the accounts is in T format. The left hand side is the debit side, the right hand side is the credit side. This is the cash account. Okay, my asset increases, I will debit it with 5 lakh. My stock, okay, this is my inventory account, that increases by 50,000. And the capital, that increases by 5 lakh 50,000. Right? So this was the first transaction. The second transaction is deposited rupees 3 lakh into the bank. Okay. So here again there is 2 accounts, cash account, okay, and bank account. Both are my asset. Here one asset decreases and one asset increases. Okay, so already I was having a 5 lakh balance debit. Now cash decreases, I will credit it. How much? By 3 lakh. And my bank balance increases, bank my asset. So I will debit it by 3 lakh. The second. Okay. Now the third transaction. Purchased furniture worth rupees 80,000 and made payment by check. Okay. Furniture purchased. So this was second. This is third. Furniture. Again, my asset increases and made payment by check. Bank, my asset decreases. Furniture asset increases. I will debit it by 80,000. Bank is my asset which decreases. I'll credit it by 80,000. Okay. The fourth one is purchased goods on credit for rupees 70,000 from Mr. Rajiv. Okay. Purchased goods on credit. I have purchased the goods for rupees 70,000. Okay. So purchase account and Mr. Rajiv on credit. He is my liability. Mr. Rajiv account. Purchase increases and my liability also increases. So when the purchase increase, I will debit it. Goods come into the business and my liability also increase. So I will credit Mr. Rajiv account by rupees 70,000. Okay, so that's how the rule of debit and credit works. Let's go to the next example. Sold goods worth rupees 40,000 for rupees 55,000 on cash basis to Mr. Soham. Now here there is sales, revenue is being generated and on cash basis. So cash account. So sales is a revenue. It's my income. Okay. So revenue is being generated. We are like the purchases have been made. Let's say if I'm purchasing something on 2,000 for 2,000 and I'm selling it for rupees 4,000, the net effect of 2,000 will be directly shown in my capital account when I prepare the whole year's profit and loss account. Okay, so when I am preparing the particular account, I am going to give the effect of how much amount I am selling it. Okay, so I am selling it for rupees 55,000. So my sales, my revenue increase and cash, my asset also increase. Okay, revenue increase, I will credit it. This is the 55,000. And my cash, my asset increases. So cash account was already, first effect was 5 lakh. Second effect 3 lakh deposited. And now for the fifth transaction, my revenue increases, cash comes into the business, so 55,000. Okay. Withdrawn rupees 20,000 from the business for personal use. At the same time, my liability, the capital amount also decreases by the same amount. So capital account reduces as well as cash also reduces. Capital reduces, I will debit it. Cash reduces, I will credit it. Okay. So cash 5 lakh, these transactions, these are the previous transactions that occurred. So that's how my cash account will look. And now it reduces by 20,000. The 7th transaction, it says, made payment to Mr. Rajiv of goods through check. Mr. Rajiv account. Okay, he was my creditor, Mr. Rajiv account, and I made a payment through check. So bank account. Earlier, Mr. Rajiv account was credited with 70,000. The 4th transaction that we did, and the balance in my bank account is 3 lakh. So here my liability is reducing. At the same time, my asset is also getting reduced. Liability reduces, we will debit it. And my asset reduces, we will credit it. Okay. The 8th one. Sold goods on credit worth rupees 20,000 for rupees 25,000 to Mr. Akash. So again, the sales account. I'm selling it on credit to Mr. Akash, right? Sales, my revenue is generating, revenue increases, and Akash is my debtor, my asset also increases. Sales, we have earlier did a sales of 55,000. That was cash sales. Here there is a credit sale. Now revenue is increasing. So I'll credit it 25,000. My asset, Mr. Akash, my debtor, that is my asset, that is also increasing. I will debit it by 25,000. Receive payment from Mr. Akash through check for rupees 25,000. And Mr. Akash made a payment. So my asset is now reducing, and another asset, I'm getting a payment through check. So my another asset is increasing. So Mr. Akash account earlier was debited by 25,000. So now my asset is reducing. So I will credit it. And here the bank balance, let me just check. It was earlier 3 lakh. 80,000 was credited, 70,000 was credited. Now I am getting a payment of 25,000. My asset is increasing, so I will. So this is the 9. So my asset is increasing. I will debit it. Okay. The 10th transaction. Purchased goods worth rupees 50,000 for cash and for rupees 30,000 on credit from Mr. Kishore. Okay, so there's person named Kishore whom I'm purchasing goods worth rupees 80,000. Okay, so that is my purchases. It is increasing. I'm paying cash. That is my asset. That is reducing. And I'm purchasing it on credit also. So now Mr. Kishore is my liability, and my liability increases. Okay, so purchase account earlier was 70,000, and cash account, there are many transactions. Okay, so I am purchasing it. Okay, my stock is increasing by rupees 80,000, 50,000 plus 30,000. Okay, so I'll debit it. I'm purchasing for cash worth rupees 50,000. My asset reduces by 50,000, and here Mr. Kishore is my liability that increases. Liability increases, so I will credit it with rupees 30,000. Right? Now there are three more transactions that are related to expenses. Okay, paid rupees 15,000 as salary to the workers. Okay, now salary account. Salary is my expense and I am paying it. Cash is my asset. So salary is my expense. Expense increase at the same time. Cash my asset. It reduces. Salary increases by 15,000. Okay, and the cash. Let me just give effects of the previous transaction. How my cash account will look. Okay, so paid 15,000, my cash reduces, my asset reduces, I will credit it by 15,000. Okay, the next is received rupees 20,000 cash as commission. I received money, commission is my income. Commission is my income that increases at the same time. I have received cash for the same. Cash is my asset that also increases. Commission, income, income increase. What we do? We credit it. And here my cash, my asset also increases by rupees 20,000. So I will debit it. The 13th transaction is paid electricity bill of rupees 10,000 through check. Electricity bill, my expense. And bank payment, my asset. Electricity bill increases, expense increases. This is the 13th transaction. Asset increases. Oh, sorry, electricity bill, my expense increases. So I'll debit it. And bank, my asset reduces. I will credit it. My asset reduces by rupees 10,000. So this is how you saw that how the rules of debit and credit work, how it gives effect. There are two effects to the assets and the liabilities and our expenses, incomes. So I hope this is now clear. If you have any doubts, do let me know.